When I started to trade in 2007 and I was trying to learn how the market moves and why it moves and how you can make money, one thing really stood out. And that was everything that we use for analysis is late. So think about fundamental analysis, fundamental data. It comes out quarterly or yearly. Think about technical indicators. People talk about how lagging it can be, and all the information is coming from price. That's how all or almost all indicators are calculated. It seemed that the only source of truth was price itself. If many buyers tried to buy, prices moved up, and then news usually followed. If many sellers started selling, price fell, and then news followed. I'm sure you've heard of this term. It's called price action. So instead of talking about a strategy, and if you've always wanted to interpret and understand where the market is going by just looking at price, this is a great video for you. In this video, the first half, we'll talk about how and why you should look at price. Why does it even move? We'll talk about FIIs and DIIs. And in the second half, we'll talk about 4 market structures and how you can identify supply and demand zones. So let's get started. So I'll keep the first part of this video really quick so we can move on to the analysis part really fast. So the first thing you should do is only analyze Nifty 50 companies or maybe Nifty 100 companies. Don't go below that, because when you don't have liquidity, price action does not work. The second thing you should know is that you should always use this on a higher time frame. You can't expect price action to work on a minute or 5 minutes. I have friends who are very successful at doing this at lower time frames, but I think that's a learned skill. So if you're a beginner, please use this on a daily, preferably on a weekly or monthly chart. It works very well on higher time frames. So let's get started. The first thing you should know is that over a long period of time, only institutional investors can actually move the market. Retailers can also move the market, but generally there needs to be a good bull run happening like we saw over the last 2 years for that to work. So in this video, let's assume that FIIs and DIIs are the people who are actually making purchases and moving the market over a long period of time. Now, I wanted to imagine this. Imagine you're a foreign institutional investor with 10,000 crores and you have to deploy this in a bunch of stocks. Now, let's say you choose one stock. I'm going to choose Reliance over here as an example because we all know Reliance. Now, do you think they can deploy this entire amount in one company in a few seconds? I'm waiting for your answer. The answer is no, you can't do that. What you'll have to do is, let's suppose a portion of this is allocated to Reliance or XYZ company. They will stagger the buying over a long period of time. So they'll have a buy, then they'll have another buy, then they'll have another buy order, then they'll have another buy order. And usually when many institutions are actually placing buy orders over a long period of time to accumulate, I'll use the word again, to accumulate a stock, generally the stock will look something like this. Because many institutional investors are trying to purchase, say, HDFC Bank or Colgate or MRF or any company over a long period of time, you'll see dips and people purchase. That will result in an uptrend. The opposite is also true. They can't suddenly sell stock. So as they distribute, a distribution looks just the opposite. And you will see a downtrend happening like that. So this is pretty straightforward, right? Long-term accumulation and long-term distribution creates trends in the market. Now, let's use this information and see how we can identify how a small rally like this can take place or a small fall like this can take place using 4 market structures. Before talking about the 4 market structures, you need to understand 2 types or 2 categories of candlestick charts, okay? Now, this is going to be new. It has a very weird name. People call it exciting and boring candles. Now, why do they do this? It's very simple. What investors or long-term investors hate is freak trades, volatility, lots of movement in a stock intraday or over a week for no reason. So if you have a stock like this with a full body and a huge line, like look at this. I have exaggerated this on purpose. Look at this candle over here. Isn't it weird? You have an opening, you have a close, but you have a really high and a really low. This is the wick over here. Does this seem like either the bulls or the bears actually won? Doesn't seem so. And then you have just the opposite. So imagine this is a candle over here. This has no wick at all. It opened strong, moved straight up, closed strong. Now this is what price action traders call is a boring candle. I like to call this like a volatile candle or an ignorable candle, but okay, traders call it a boring candle. And then traders call this an exciting candle. I don't know why they call this exciting. I would rather call it a full candle, a candle which has confidence. This looks like a confident candle, and this looks like a candle which will probably be bullied. But this is the kind of price action we like, because here you know if this is a green candle, that prices actually moved up and they actually closed, and there is some confidence over here. So just remember, this is a boring candle, this is an exciting candle, or I like to call it is a weak candle, and this is a confidence candle. So let's understand how this works in a rally-based rally situation, which is what we'll talk about next. First, let's start with the rally-base rally. This is very simple. You have a rally, you have a base which is sideways, and then you have a rally again. Now, what we want over here is that this is made up of exciting candles, right? This area over here. Okay, and also this. You want the other one, like this one, to actually be made of boring candles. Okay. Now, think about it. Forget about the words exciting and boring, but when you see a rally, you want confident bars moving clearly up, and then you want some indecisiveness. It's like Usain Bolt running, taking a breather, looks like this, and then going straight up. Again, it's an exciting candle. Now, whenever this happens, you know, of course, we know this as an uptrend, but you have confident candles going up, sideways, which is indecisiveness. These could be doji bars, and then market moves up again. I want you to remember this. Let's look at an example over here. You'll see here that the market went up. You can see nice, confident bars. Also, you don't really see a lot of wicks over here, do you? Then you have 2 bars or a few bars actually sideways, and then the market moves up again. This is simply a rally-base rally. Now, the opposite of this is, imagine you see the same pattern, but in the movement up, there were indecisive candles. And then the sideways was also indecisive. You can expect that the breakout that happens is not likely to be very confident and move up, because these candles itself were indecisive. Now, how is this useful? When you see a rally-base rally and there is a pullback after this near the base, the likeliness of an up move from here is actually very high. And of course, if we go below the base, that means the trend failed and the entire trend will now move downwards. But one way traders use this pattern is there is a pullback, they take an entry, they keep a stop loss right below the boring candles where they were sideways. And then if there's a movement up, that's a nice risk-reward ratio to actually go long on this trend. The next pattern we learn is the drop-base rally. So drop-base rally. Let's see what it looks like. It's very simple. You probably guessed it. Market moves down. There's a sideways and the market moves up again. And just like we learned before, this down move has to be exciting candles. So does this up move or this rally also the same. The sideways, as you know, have to be indecisive, boring candles. So it will be this, and this has to be boring candle. So this could be a bunch of dojis going up. Just like the rally-based rally, you expect the market to actually, if it falls down from here, you expect a quicker reversal because there are a lot of buyers. So even over here, you expect market to come down near the base, and you expect an up move because there are a lot of buyers. Don't use this as a system, obviously, to actually trade. I think what helps you over here is to understand market psychology by looking at these candles. It's almost like a story unfolding of distribution happening and then buyers coming in, overtaking all of the supply, creating boring candles, creating candles like this. Then the buyers beat the sellers and push the market up. It is actually like a story, isn't it? Now, I said there are 4 market structures to look at. We looked at 1 and 2. The other 2 are just the opposite. So just like we learned the rally-based rally, the opposite would become drop-based drop. And the opposite of drop-based rally would become rally-based drop. You can just invert it and do it. I would love if some of you can find the opposite of this and take examples and put it in the comments below so we can learn together and see if you found the right rally-based rally, drop-based drop, or the opposite from there or not. If you have any questions, put it in the comments below. I hope this intro to price action was useful or interesting. Let me know what other videos we should do in the future. See you next time.